Hi everyone, welcome to the channel. This is my first video. This channel documents my real-time journey using a leverage investing strategy on margin. We'll explore the tactics I use, the trades I make, and the lessons I learn along the way. This is for entertainment purposes only. The why behind the strategy. I'm young. I'm exploring a strategy to go beyond standard returns. This approach combines a core portfolio with the use of leverage to amplify potential gains. It's a proactive method for generating income while building a portfolio for long-term wealth. So this is the calculated growth strategy. Initial capital. I start with my initial investment capital. This strategy doesn't require me to contribute money often, with the exception of adding funds during severe market downturns. Core portfolio. I allocate 80% of my capital to SVMO and 20% to IDMO. These ETFs are the foundation of my portfolio, chosen to maximize my reward to risk ratio and outperform the S&P 500, with the added benefit of being low maintenance. Leverage. I introduce an external margin loan to amplify the potential for growth. This is the key component that leverages my initial capital. Income generation. I generate income to help offset the interest on the margin loan by selling options. This strategy is to sell puts with a high probability of profit, around 85%, on stocks with high implied volatility. A major advantage that I take on Robinhood is that interest on the margin loan isn't charged on the options collateral until shares are assigned, which helps me manage costs. Contingency plan. If I get assigned shares from selling puts, I don't panic. I switch to a wheel strategy by selling covered calls on those assigned shares until I have at least broken even. Then I sell the stock. Dynamic risk management. I actively manage my risks by maintaining a margin buffer. I aim for an initial buffer of 65 to 70% before selling any puts, and I expect it to drop to as low as 35% after the puts are sold. I also adjust my margin usage based on CNN's Fear and Greed Index, using more margin during market downturns. In the case of a severe market downturn, I can add money from my paycheck into my account to reduce the chances of a margin call. The ultimate outcome of this strategy is accelerated portfolio growth and income generation. So here's a diagram that simplifies all that. So we start with an initial capital, and we invest the initial capital into a core portfolio of 80% SVMO and 20% IDMO. After that, we take on a margin loan that acts as leverage. We take as much of a loan that will give us an initial buffer of 65 to 70%, as shown on Robinhood. With the remaining margin loan, as we have a big buffer, we'll use that remaining margin loan as options collateral or income generation by selling puts on high IV stocks to generate premiums that pay off interest. Along with that, we have dynamic risk management. We reference the Fear and Greed Index for margin usage, and if necessary, contribute paycheck to increase the buffer. At the end, the goal is an accelerated portfolio. So for reference, this is the Fear Greed Index to margin usage formula. The Fear Greed Index measures overall market sentiment from 0 extreme fear to 100 extreme greed. It shows whether investors are mostly worried or overly optimistic. So as you can see right now, it's 62. So you would use that table and look at the columns in the Y and plug in based off the number. This is where the real fun starts. If you look at the buying power and the margin used is 19K. This is the loan I'm actually being charged interest on. If you look at options collateral, 9.7K, I'm actually not getting charged interest on this. But what is it? The options collateral is from these sold puts that are actually generating me income They're paying off the interest from my 19K margin loan that I'm using. And these sold puts are based off a list of high IV stocks that I've gathered these past few weeks. If you look at my margin status, it's low risk, and my portfolio buffer is 40%. Initially, without these sold puts, my buffer was actually 60 to 70%. But after selling these puts, my buffer decreased substantially because the maintenance ratio for sold puts are actually 100%, while holding the single stock is 25%. See here. Meaning, if I get assigned these shares on a market downturn, I would actually have a higher buffer, thus reducing my risk of a margin call. So this is my core portfolio. Ignore the Google because I just have a Schengler one that I can't get rid of. But everything else is SBMO and IDMO. I'm excited to see where this strategy goes forward. I'm going to show my returns. However, take note that it's not these past returns are not following the strategy. So from here on forward, I will be pursuing the strategy and keep you guys updated on how it goes. Thanks for watching.